So what I'll do is I will just get started and start to go through these questions. Actually, before I do that, I just want to announce one of the things I'm thinking about doing, and I'd like your feedback on, is getting some people to do Facebook Lives with me who have particular expertise in certain areas. So, for example, I'm thinking of getting and in talks with someone to do a special about mortgages and property. So you can ask a mortgage broker about what's going on with mortgages, any information that you might want or questions. And another one is I'm trying to put together a possibility of doing one with an accountant who can give you all some real guidance on what's going on with the latest government schemes, because it's a very fluid position that we're in, and I know there are a lot of people who are asking questions, and I'm going to do my best to give you a view, because that's all we can do at the moment is give a view on what's the latest situation, because it's very fast moving and evolving. So if that idea in any way sounds appealing, then do let me know and we will make sure it happens. Now, I'm going to start going through the questions that you have asked me, and they're in no particular order. They cover a whole range of things from sort of macro ideas to pensions and insurance, investing. So it's great that you've given this quite a wide spread. So I'm going to start off with one of the first questions I was asked about health insurance. And the question was, what should we do about health insurance, given that all private beds have rightly been signed over to the NHS? I pay £238 a month. No way that remote access benefits justify that. Now, one thing I want to bear in mind, we did a lot of work on this, and Andy in particular, he'll probably write some bits and pieces in the comments to this video as I'm doing it live. Now, the one thing is the insurers have, at the moment, largely not changed their position when it comes to their policies. So, it means that if you were hospitalised because of coronavirus, then you would be covered under most of the health insurance policies out there if you already are an existing customer. And why that's important is because a lot of the policies give you a cash benefit for staying in hospital. So that can be £100, £200 a day. So if you end up contracting coronavirus and you end up being in hospital for an extended period of time, then the money that you will get, the benefit, will probably far outweigh that £288 premium. So obviously, I hope that that happens to people, but we've got to be realistic. So you've got to take that into account. The insurers have said that they're obviously using, or the private hospitals are opening up to the NHS, but at a cost. They're not exploiting the situation. And so it may mean that some of your benefits you might not be able to access them. But bear in mind that I want you to think about is that you pay for health insurance with the idea of not claiming. That's the idea of insurance, really. You're trying to protect against a potential event that you don't really want to happen. So the idea is, in the perfect world, you have an insurance policy, you don't have this bad thing happen to you, but it's there just in case. So ignoring the coronavirus and the position that we're all in now, then you wouldn't normally be claiming on a policy with any luck. So it would be no different if you are fortunate enough over this period of time till things return back to normal. You will hopefully you wouldn't have to make a claim anyway. So you'd be in the same position. Yes, there will be some issues maybe if you wanted to have a particular procedure done, but that is the reality of the NHS as well right now. So the other thing is, if you, Andy actually spoke to me earlier, some of the insurers are boosting their benefits for people who stay in hospital. So Vitality is one of them. Andy's, I think, just written some information in the comments there, which you can read. Basically, they've upped the cash benefits if you end up in hospital with coronavirus, which is quite a big thing for them to do. So that's a real positive. The other thing is, if you cancel a policy, remember, you're going to probably want to take out another one once this is over. And there's no guarantee that A, you'll get the policy on the same terms, because terms and conditions will change. You may be on a moratorium period. You may end up having the whole coronavirus issue excluded. Insurers are doing that at the moment. Well, not yet, sorry. They will probably do that in the future when they have new policies. So you've got to bear that in mind. So I can't tell people what to do with insurance policies. It's a personal thing, down to budgets, etc. But these are the things you should think about at the same time. Next questions that we had. Somebody was talking about they had an AVC, which is what they call an additional voluntary contribution through their work, and they were saying they're not bragging, but they have a lot of money put in it, and they say they can't instruct the AVC management to sell units and hold everything in cash, then buy back at a later date, like you can in the stocks and shares ISA, and they're saying, why can't I? Now, the idea of an AVC is it depends on which type. I'm not going to get bogged down into the different types of AVCs, and it depends on your pension scheme, whether it's defined benefit or defined contribution. But the idea is you're in an AVC because it's for like your pension is going to be for the long term, and the person doesn't mention when they're trying to access the money. They're trying to, if it's assuming it's for a defined contribution scheme, what you're trying to do therefore is time the market, and no one ever gets that right. And you're better off being in probably a well diversified portfolio, because as I mentioned previously, it's not just this financial crisis you're going to be investing through. When we recover, there'll probably be another one or two before you retire. So it's the same thing that you're going to encounter in the future. So trying to time the market isn't necessarily a good thing. Also bear in mind that your options are incredibly limited, and so you can't hold cash. You'd end up sometimes in money market funds if you have a choice. And I remember from the financial crisis, the money market funds aren't cash. There are instruments in there that sort of replicate cash, and they ended up selling off up to 5% during that period. So cash funds aren't always cash, so bear that in mind. So you may be able to have choices that you can change, but I think because it's very clunky and there will normally be a very limited choice, trying to time the market isn't even possible. You'll probably miss the bottom, and it isn't necessarily a wise thing to do. In your previous podcast, you mentioned how dips due to viral outbreaks tend to be shorter term. You get bounce backs to previous level once the issue in hand has died down. Obviously, this is more significant, but given the stimulus packages we are seeing, is there a possibility that once the threat of the virus subsides, things will be overstimulated, or do we see this causing more lasting, irreparable damage that will need more nurturing once the immediate threat subsides? Now, it's a good question, and we don't know. Now, somewhere else in the question list, there's people talk about hyperinflation as well. So that's one of the things of where perhaps if you keep overstimulating, so you make the currency weaker by cutting rates or printing more money, then things will cost more. You need more pounds that are washing around the system, and it will drive up inflation. One thing I would say on that is that if you look at the financial crisis, everybody said that would happen afterwards because we had all this stimulus back then. Maybe not to the same scale that we're going to end up having this time, but we had it last time. And inflation never, ever escalated in such the same way. It never peaked. So I'm not saying it won't, but we have a 12-year window after the last set of stimulus. We were being stimulated for the whole time as well, because interest rates never really got back. Well, they never got anywhere near back to normal. So that means, if you take that as a guide, we probably are in the lower for longer regime when it comes to interest rates. And it is possible we could get hyperinflation, but history says recently that perhaps the odds of it are maybe overstated. Now, on the point about will we bounce back, stock markets are interesting because they tend to discount what's going on. So 3 to 6 months ahead is where they tend to look. So we'll tend to bottom way before we get the economy bottoming. And so therefore we could see something of a bounce back at some point. Like I said before, it could take years to get back to where we were. The danger we've got is that that we could have some huge damage because of the number of people that become unemployed, and we end up in some kind of depression. It's not guaranteed, and I don't think it necessarily will happen given all the stimulus, but we just don't know. So, from an economic standpoint, it's going to take a long time. From a stock market and investment standpoint, the end will probably be sooner than the economic downturn. That doesn't mean it's going to be tomorrow, and it certainly doesn't mean the market won't fall further. Somebody actually mentions later on, if you've cashed out, when do you reinvest? Now, if I knew that, I'd be not doing this recording in my living room. I'd be doing it on a desert island somewhere. But the key things, I think, just generally for people, I talked about it in midweek markets as indicators. They don't guarantee the market's going to turn around. We can never get the bottom. But if you look at history, there are lessons, and it's when the VIX, the VIX, if you Google that, you can see it, which is the kind of, it's called the fear gauge for the market. But what it does, it's really a sort of a measure of volatility of the S&P 500. That's up about 60, and it's been going between 60 and 80. Historically, it's normally near 20 or below, and recently we've been down to like below 15. When that gets down towards a 200-day moving average, that has been a bit of a all-clear signal for markets in the past. So it doesn't mean it will be this time, but that number is 20. We are still up above 60. The bond market needs to settle down, and we need to see more like stocks being above their 200-day moving average to get, they call that breadth. So we don't know when is the time to reinvest, but if you've cashed out and the market is obviously at a lower level, then you are winning anyway if you've reinvested. You can also drip in. I think people always think they've got to get the bottom, and it's been proven the strategy, if you've got cash and you think the market will fall further or you're worried, is to drip in because of pound cost averaging, which I've talked about previously. So it's something to bear in mind. I don't know when the market will bottom. There are signs that this could be just a bear market rally that we've had in the last week, and the odds are that it probably is, and we're going to end up testing new lows. I hope we don't, but if you look at previous stock market crashes, 2008, go back to the dot-com bubble, you get the biggest rallies in bear markets, so that can be a negative. That's just reality. Next question. Somebody's asked about transferring a DB pension, so defined benefit pensions, final salary. They have. Is this a better time to be transferring defined benefit pensions to invest in low-cost SIPs? Logic would dictate transferring out when the transfer value would be a lot more funds to invest for the long term. Are DB pensions going to have difficulty meeting their liabilities from now on? That's two questions which are interesting. Default position by the FCA is that people are generally always better off staying with a defined benefit pension, and it's because it's based upon your salary and your term of service. In markets like this, obviously people now are learning that when they're getting close to retirement and you get an event like this, if they hadn't diversified into safer assets, which even themselves have fallen, then you can end up being like seeing your pension pot tumble, and it will have an impact on your retirement. It doesn't mean you have to take all your money up front, as we've discussed in the group, but so therefore the final salary schemes therefore are more like gold dust now. The issue you've got is the value that they calculate will be based on their desire to get rid of you from the scheme because of future liabilities, but also based on projected returns. They come up with a value, and it depends how they do that. So you might not necessarily get a bigger value now. And also, if you come out of there, you may get the market might continue to fall further, but you are giving up a guarantee for something that is much more risky and not guaranteed. So you have to bear that in mind. So I'm not sure it's about timing. I'm not sure that's a good idea at all. On the difficulty, yes, this will be an issue going forward. We're already seeing signs of final salary schemes being reported trying to take request payment holidays in terms of funding their schemes, asking trustees for a break, and that's because of obviously what's going on in the economy. Now, there will be concerns, there was in the financial crisis, about schemes being funded, and that will happen again now. Obviously, I'll put a link to it. For people in those schemes, they might feel panicked, but their schemes are protected by the Pension Protection Fund. I'll put a link to it so they can read it, so that it will give them a backstop they should feel better about. But this is just the reality of the world we are in. So yes, there will be some people, there will be difficulties in meeting their liabilities, but pension funds do tend to invest in lower risk assets. Not all the time, but they will be a favouring of gilts, because if you think, like an annuity, they've got to basically pay you a pension. Gilts and work well for that because they pay a recurring interest rate. But so we will find out, obviously, in a not too distant future about deficits, etc. Next question. What have we got? Right, this is an interesting one on income. So if you're a SIP investor who depends on some extent on dividends and interest from a diversified portfolio to pay bills, do we believe all dividends will be pulled due to the financial strain on most companies, leaving such income investors nursing paper losses and little to no income? It's a possibility. I've had a list of companies that have already been pulling dividends or issuing guidance that they're going to not pay dividends. It happened in the financial crisis. It will happen again. Now, you've got to factor this into your planning, that there might be a dip in dividends. If you invest in shares directly, that's going to impact you more. If you invest in equity income funds, which tend to hold 50 to 100 stocks, then they might be able to manage their payouts. And investment trusts obviously can manage their payouts better because they can retain income for future years. So they've always had a good history. The one message I would like to just emphasise on this question is that if you build an income portfolio, it is good practice to always have a year's income or two, depends, you get different views on this, held in cash within your pension. Because what happens then is you're able to weather storms like this. So you end up having the cash buffer, which your income can be taken out of for that year or two, and then that cash buffer can be added to naturally by the yield from the investments that you're in that are producing an income. So that's something that I think is a very important point. Question on the direction of interest rates given the government stimulus. I've heard two schools of thought. First being like 07, 08 crisis, will we have depressed interest rates for longer? Yes, I think that's more likely than not. That's what the market's pricing in. The other is that all money printed by the government could lead to hyperinflation. I've already covered that. I had a question about negative interest rates. Will we go negative? Now, the Bank of England have suggested that they don't want to go negative. We've seen negative interest rates in other places, so it's a case of never say never, but they've suggested that they don't want to go down that route. On a mortgage front, where your mortgage goes in relation to interest rates depends on the type of mortgage. If you've got a tracker, then it will tend to track the base rate if that's what your T's and C's say, but also the terms and conditions, because some of them won't keep tumbling even if you went into negative territory. Is the likely bounce in US stock market as a result of their stimulus or a dead cat bounce, or the start of recovery? And will I take the FTSE up, or are markets focused on their own country's problems? I've covered a lot of that already, but I do like this idea of what will happen to individual stock markets, because what's happened over the last few years is that stock markets the US stock market has outperformed massively over probably the last 3-4 years. It was the one where we've had crises in other markets. The FTSE is nowhere near its all-time high right now, but it really wasn't recently. And whereas we had the S&P and 500 and US stock markets setting new highs, so they held up much better in the last few years. So it was almost a case of, if you held US stocks, you would have done well. And it's just because of the environment that we're in at this point in time. And the pound fell as well, which is one of the reasons why you get funds that had heavy US exposure, Vanguard being one, had done well. I don't know the answer to whether we're going to get some deviation with different stock markets, but I'm starting to try and look out for it, because the US is very it's in a precarious position because of the way they're responding to this crisis, and we're already seeing the rate of their cases explode, and it's in danger of almost going parabolic. And if that's the case and their economy gets shut down, then even more so, or there is even a bigger sort of recession, then it will impact their stock market more. I like the idea that we've got the UK over here that starts to perform well and get back to normal. And we did see that difference in Chinese equities. When the rest of the world was selling off and collapsing, Chinese stocks were making new all-time highs. Now, some of that was down to stimulus, because from the government in China, because if you look after that, then the stock market over there did sell off as well eventually. So I don't know the answer to that. I'm watching for it, but there's a phrase which is, excuse the pun, is that when America sneezes, the rest of the world catches a cold, and that is normally for economics and stock markets. In this case, it will be coronavirus, but I think we're going to be heavily led. You see up days in America still influencing our market, and down days influencing it. Someone asked about they're doing FIRE, so that's the Financial Independence Retire Early. So those people, this question is, thanks for your support at this difficult time. I'm 55 and 2 years into the FIRE bucket portfolio, cash bonds, equity. Hopefully I'll be able to weather the storm, but will miss the valuable compound growth over the next few years. Any advice you can give? They don't have a financial advisor. What they really want is a calculator, they go on to say. So we've got a calculator for Money to the Masses. You can search it on our site if you type in pension calculator, but I will add it into the comments so you can look at the impact on your retirement. And I know you want to do this, you call it a Monte Carlo style calculator, which is one that you can vary the bond, cash, equity content, and it can sort of look at the impact on your retirement. I will forward you one of those actually as well in the comments. Vanguard have one. I went and looked for it and found it, which is quite useful. Somebody, going back to defined benefit schemes, somebody said that they cashed out and they are worried that the scheme's going to come after them for their money. Now, I don't see how that can possibly happen, because the idea is they get rid of you, and the money they pay for your cash transfer is for getting rid of your liability. Because if it worked one way, it could work the other way. You could go back and say, I want more money. So I think that's something that, unless somebody tells me otherwise, there's nothing to really worried about. Now, on the next part is on a lot about what's going on with the current grants out there. The imports for the self-employed. I've just flicked back and seen a few comments from people on there, so thank you for all the comments you're putting in there. Make sure you say hello. On the government support for self-employed and employed people, there are people asking what my opinion is. Now, this is only a view, and it's an informed view from reading what's going on, what's other people's in government's views, and people who are accountants, etc. And so I see that somebody asked the question regarding is the people have put on there, one of them is about the self-employed and company directors with dividends. Now, what I've seen so far, and again, this is all fast changing, and this is a view at the point I'm doing this video. So you have to check the official government guidance that's going to be continue to be pushed out, and as people interpret it. And I'll share some links. I've already shared some links actually in the group, pointing to some of these schemes and some of the interpretations of them. Now, for self-employed people, I know that the people who are directors of companies and pay themselves dividends are falling through the crack, as it were. And that's because they pay themselves under PAYE, normally a very low salary, and then they have the dividends element. Now, they aren't covered under the self-employed scheme, but they potentially can be covered under the employed one, where you can furlough workers. And it won't be their dividends that are covered. that's been confirmed. It will only be the salary that they pay under PAYE potentially. Now, there's different schools of thought on this, because if you were a company where it's just you, then the difference between the two schemes is that, as it is now, and it's been interpreted, under the self-employed scheme, so the help for them, you can carry on working. And so that opens up a moral minefield that you can claim under that scheme and still work. And the reason that is that way is because they want businesses to function and they want the economy to recover. So that is, you can question the morals and all of that if you were to claim and you still worked. But you are technically, that's what the government is allowing. Under the PAYE scheme, so the scheme for people who are employed, being furloughed means that you aren't supposed to work. And the issue that you have, there's different schools of thought on it. Some people are saying that directors could be covered under this scheme. In fact, the government links to it and says they can be covered under this scheme, where they could furlough themselves. But then I've seen another school of thought that says, well, how can that happen if you are the only director in a business? It's just you create a limited company which you work at. Because in theory, you have to tell a worker that they're furloughed, and therefore tell them when they can come back to work. Well, if you're the only person in the business, then to do that, you must be working in order to tell yourself and send a letter. So there's some accountants that are out there that are starting to suggest that they aren't comfortable with the idea of using that scheme, and there are others that have a different school of thought. So this is something that they're waiting for clarification on, whether companies where you are a single director, you're on your own, whether that can happen. Of course, within companies, if you're a limited company, you can use the rules for PAYE workers for everybody else within your company anyway. The other questions I've got here, I had somebody say they're not eligible for the self-employed scheme, but they were a 0-hour contracted worker for a company. Now, they are included under the PAYE, the employed scheme, but you had to work, I think the date's February 28th, go and check the full guidance, and this person worked in September, so it's unlikely they'll be covered. And it means, because at the moment these things can be backdated, so there's a case where people who maybe had lost their jobs before the schemes were announced can go back and ask to have their wages paid basically via HMRC, so via the furloughed route. So that gives, I hope, some clarification on that. If you have any more questions on it, then do fire them in. And as I say, I'm trying to get somebody who is perhaps an accountant who has a view on lots of these different things, because there's lots of people out there who are asking questions around it. One of the things that I would urge you is to speak to your accountant. Don't leave it, because you want to know what your options are before you get there, because they are inundated, they're incredibly busy, as you can understand, but you should have a good working relationship with an accountant anyway, and you could say, they will have done this for other people, so you can go to them and say, how is this going to impact me? What can I claim? Who can I claim for? How can I keep the business going? Because obviously there's other measures that have been announced in terms of delays to VAT, self-assessment payments, there's loans, etc. So as ever, we'll put a link to the official government guidance, but these things are changing all the time. I think I've covered pretty much everything on the questions. If there's any others on there, then do shout quickly before I wrap up. But I'm just checking back through, and this is one of the others. Somebody put that they were worried about their investments, and could they not hide them, but if we would all pay for this at some point, then the government is going to go around raising tax rates, and they were worried about the idea that, or how could they potentially protect themselves from that potential grabbing from the government. Now, we don't know how they will end up making people pay for this. They've already suggested that it's going to be the self-employed are going to have to pay a bit more. Everybody's going to have to. I think you can only go by the rules that exist now. You play the team that's in front of you, and the ways to protect yourself from taxation will still be stocks and shares ISAs and still things like pensions. So that is. There's no point trying to predict for the future. We don't know where we're going to be, and we'll have to just play the team that's in front of us. So, I hope that's been incredibly useful for you. As ever, I'll try and do these weekly because there's loads of questions people keep asking and things in the group that I can't always respond to that I like to cover in these Facebook Live pieces. So until next time, do send in your questions. If you think the idea of getting an accountant or a mortgage advisor on these is useful, then please do let me know.